The stock market is once again near all-time highs. Many stocks have reached stretched valuations, but even in this market, there are still some undervalued companies worth a look at. In this video, I will look at a few undervalued companies that are potential buys. If you do like this sort of content, then please do hit the like button and subscribe to the channel for more. To look at the companies, I will now jump into my stock valuation spreadsheet. This is a great tool where you can see an overview of a business, so you can see their financial metrics, some of their other key metrics, the analyst ratings, some technical information, recent earnings reports, and also dividend information. So these are some of the key metrics that I like to look at before doing a deep dive into a company. But the best thing about this spreadsheet is that you can value a company using it. So we've got various different valuation methods: the discounted cash flow model, Benjamin Graham model, multiples model, and the dividend discount model. And you will come to an intrinsic value for the company. I've made a video on how to use this spreadsheet, so do check that video out. And if you did want access to this, then click the link in the description. The first company that I will be looking at that I believe is undervalued is Adobe. So this company has recently taken a beating, and actually over the past 5 years you would have made a loss if you had invested in this company. So obviously over time it has gone up, but we can see that it has recently dropped to recent lows, and it hasn't been at this level since around 2022 or 2023. A lot of the reason for the decline is due to the recent AI hype. Thanks to AI, a lot of creative design can be done for a lot cheaper using other platforms such as Canva, and also using AI tools such as ChatGPT, also Gemini as well. So Google has created its own software as well that specifically create AI generated images and videos. So many people believe that this will take sales away from Adobe. However, if you look at the financial metrics of Adobe, it does not seem to have been affected by AI at the moment. So just looking at their revenue, you can see that it has consistently grown year over year, and that's even despite the recent AI hype. The company's revenue has grown over the past 5 years over 14%, and the profit margin is still really healthy at 30%. And if you look at their key metrics like their PE ratio and also their forward PE ratio, it does look quite low. So the PE ratio is just over 20, and the forward PE ratio is a lot lower, and that's at 14. And these other metrics look fairly healthy as well. So you've got your current ratio, which is above 1, and your long-term debt to equity, which is well below 1 as well. And just looking at it from a cash flow perspective, you can see that it does seem to be undervalued. So at the moment, the price to free cash flow is around 15. So if it's below 20, usually that means it's really undervalued. And obviously you can do your own discounted cash flow valuation to see the actual price. But just looking at these metrics and the revenue growth of the company, it does look undervalued. Also, analysts have a price target of 457, and the current price is a far away from that. And if you just look at their earnings, you can see that they have been beating expectations, and you can see the growth in their revenue quarter over quarter and their earnings per share as well. And if you look at their net profit, that's also been increasing significantly over time, and it's actually accelerated in the past few years. That's despite the AI hype coming in recently. So this seems to have benefited the company. And if you look at the shares outstanding, this has been declining over time. So it does look like the company is buying shares at a decent price. And if we just look at the free cash flow, you can see it does look fairly healthy. And this website I'm looking at here is my ultimate stock valuation tool, so you can use this to see key metrics of a company, but also you can work out the discounted cash flow valuation of the company, and you can put in your own assumptions. So you can apply your own discount rate, your own growth rate for the next 1 to 3 years, and your declining growth rate, so that's after 4 to 7 years. So this is something that you can use yourself to come to an instant valuation of the company. If you don't like my other spreadsheet where you have to populate all the cells, this is all fully automated. So if you do want access to this, then just click the link in the description. The next company I will be looking at is also another software company, and that is Salesforce, ticker symbol CRM. This is another company that has really been declining over the past few years. So if we just look at the stock price, we can see over the past 5 years, the company has also been in the red. So it's gone down over 10% in the past 5 years. And over the past 1 year, it's down 15%. It does look like this company has been declining. However, if you look at the company's metrics, like its revenue, it seems to have been improving. Also, its net profit has seemed to have been improving, and especially their free cash flow looks very healthy and very predictable. But this seems to have been another stock that has been hit by the AI hype. So we can see the price target is 331, which is a lot higher than the current price. But of course you can do your own discounted cash flow valuation to see what price you would be willing to pay, and there's obviously other models as well, and you've got an element where you can put in a margin of safety. But if we just look at some of the key metrics, we can see their revenue has grown over the past 5 years over 17%, which is very impressive. But it's important to note that I believe a lot of that would have come from new acquisitions, and it may not necessarily be organic growth. Their profit margins are still healthy, and their PE ratio, although their PE ratio is above 30, their forward PE ratio is below 20. So this does look like a very attractive price just looking at this metric. And obviously you've got current ratio, long-term debt to equity. These are both figures that we like to see. And then you've got price to free cash flow. Again, as I mentioned in my previous company, what I like to see is the price to free cash flow being around 20. That's usually a good indicator that the company is potentially undervalued, and this does look like the case. But obviously you will need to do a discounted cash flow valuation to see if that is the case, or you can use my other tool, which is also available in the link, where it will calculate the intrinsic value for you. The next company I will be looking at is S&P Global. This is a company that has recently declined in its share price. So we can see over the past 1 year it's gone down about 5%, and over the past 5 years it has seen impressive growth of 34%. But more recently we can see that the share price has declined. So if we just take the top here, we can see that it's declined by around 13%, and it's around the same level that it was in April 2025 when we had the market sell-off that was due to tariffs. So it does look like it's come down to an attractive price after being at all-time highs, and we can see that the price target is actually quite high. So we've got 619, whereas the current price is only 479. So there is definitely room for growth there if you follow these assumptions. But again, you can do your own discounted cash flow valuation to come to an intrinsic value for the company. We can see that the revenue over the past 5 years has grown over 16%. And if we just look at that in a visual format, we can see that the revenue has consistently grown over the past 10 years. and its profitability has also been increasing. The profit margin is currently at 27%, which is very healthy, and the PE ratio and forward PE ratio look quite attractive. So although it's above 30 and above 20, historically this kind of company does have a higher PE ratio, so it does look like it's at a good level here. We have a current ratio which is below 1, so ideally I like to see it above 1, but it's not too far off, and its long-term debt to equity is well below 1. And also if we look at their price to free cash flow, we can see it is around 27, and there's also growth in its return on assets, return on equity, and return on invested capital. And just look at their technicals, we can see it's down 17% from its 52-week high, and I believe that it's all-time high, so it has dropped significantly. Also, it does pay a very small dividend similar to Salesforce. So if we look at Salesforce, that also pays a very small dividend as well. And we can see, just looking at their earnings, that the company has continued to grow and beat expectations as well. So obviously do your own research on the company and do your own discounted cash flow valuation and other valuations for the company. But I do personally believe that it is in a good range to be buying. I've personally added to my position, so this is one of my largest holdings, and I have recently been adding in this dip. And another company which I believe may not be as undervalued as the other companies, and it has recently seen a surge as well, but I do still believe that it is at a decent price range. So I will just put it in here, and that company is ASML, that famous Dutch-based semiconductor company. So we can see that the stock price has obviously grown a lot over the past year or so. So it's up 17% over the past year, and just recently we can see that it has gone up over 42%. So although I do believe that this is a huge run-up in the price, I still believe that it is at a decent price range. It may not be as undervalued as the other companies, but I think that it is still something that is worth looking into. And the main reason is just looking at their PE ratio. So you can see that although it's quite high at 39, historically ASML I believe has had a lower PE ratio, and especially for a semiconductor company that isn't too high. If you look at other semiconductor companies, like let's just say Nvidia, let's see what their PE ratio is, 53. So people still consider Nvidia to be decently priced, and that's got a quite high PE ratio. And if we just look at another semiconductor, AMD or maybe Broadcom, we've got PE ratio which is a lot higher. So I do believe that although the PE ratio is quite high, it is still at a decent range for a semiconductor company that is growing at the rate that ASML is growing. Also, the key metrics are a lot more impressive than the previous companies we've looked at. So just looking at their return on assets, equity, and return on invested capital, you can see they're all well into the double digits. And also just looking at their earnings, we can see the revenue quarter over quarter has increased significantly, and its earnings per share has also increased quarter over quarter as well. So again, this may not be the best undervalued company, and it may be more into fair value territory, but I do believe that it is something that is worth looking into. The next company I will be looking at that I believe is undervalued is Novo Nordisk. If we look at this company, they have really good financial metrics, but we can see that their share price has recently seen a decline. So over the past 5 years, it has grown over 65%. But if we just look from here, which is June of last year, we can see that since then, the share price has significantly dropped. So it's been down over 58%, which is quite high. especially if you consider that the financial metrics of the company have actually improved. So if I just look at Novo Nordisk, we can see that the revenue has significantly grown, especially over the past few years, and their net profit has also been increasing in a similar fashion. And if we just look at their free cash flow, it does look to be in a very healthy position. So although the share price has dropped significantly, the financial metrics seem to have improved. So that's usually always a good point to start looking into a company, because it could potentially mean that it's undervalued. Analysts have a price target of around 70, which is a lot higher than the current price. And if we look at their revenue over the past 5 years, it's grown over 18%, and their profit margin is very healthy at 35%, which is very good for this sort of company. It's not a tech company, it's obviously in the pharmaceutical industry, but to have a profit margin of 35% is quite impressive, because some of the other companies that we were looking at had lower profit margins and had less overheads, such as a company like, for example, Adobe. So their profit margin was 30%, and they're like a software company, so you would think that their profit would be higher than a company like Novo Nordisk, but we can see that's not the case. And if we just look at their PE ratio and forward PE ratio, we can see that they are both well below 20. Their current ratio is below 1, which obviously is not good to see, and their long-term debt to equity is below 1. And just looking at their price to free cash flow, we can see that this is around the 20 mark, so it may potentially be undervalued, just looking at it from a cash flow perspective. And what's really impressive is these key metrics here. So you've got return on assets, equity, and invested capital both well into the double digits, and again, that is very impressive for this type of company. And what I really like about Novo Nordisk is that they pay out a dividend as well. So obviously, if you're a dividend investor, you are getting a return while the price is at a discounted price. So the payout ratio is 35%, and the dividend yield is 2.9%. So if you are a dividend investor that's looking for growth, this could potentially be something that is worth looking into. And you've got earnings as well. So again, as I mentioned, they have been improving their financial metrics. So you've got revenue quarter over quarter has increased over 18%, and their earnings per share has increased just under 40%, which is really impressive. But again, you can do your own valuation of the company to see the price that you would be willing to pay. But this is definitely something that is worth having on your radar. The next company I will be looking at is Deckers. So this is a footwear brand company, and the share price has significantly dropped recently. So we can see just from its all-time high from the start of this year, it's down 52%. So over the past 1 year, it's 35%. And year to date, it's around 50%. However, if we look at their financial metrics, we can see that the company has grown quite significantly. So the revenue over the past 5 years has grown over 18%. The profit margin is really healthy as well at 19%, especially for a footwear brand. And we've got key metrics such as the PE and forward PE, which are well below 20. And you've obviously got current ratio, which is not only above 1, but it's also above 2. So that shows it's got a good level of assets in comparison to its liabilities. And its long-term debt to equity is really low. It's pretty much non-existent. It's 0.1. So that, I believe, is the lowest we've seen from these companies. And the price to free cash flow is also quite low as well. So these are very attractive metrics. And what's also impressive is that their return on assets, equity, and invested capital are well into the double digits. So we can see that here. So it does look like this company is somewhat undervalued. If we look at their earnings, we can see that the company has improved on many metrics, especially in terms of revenue. You can see it's gone up over 36% in terms of their expectations, and the revenue quarter over quarter has increased over 16%, and the earnings per share has increased over 23%. So it does look like this company has been improving all of its financial metrics, but obviously, having looked at the share price, it does seem to have declined, so it may be worth looking into. This is definitely something that is on my radar, and I may even be tempted to open up a starting position. And this actually has a buy rating as well from analysts. I don't believe any of the previous companies had this rating, so this is definitely considered undervalued even for analysts as well. And they've got a price target which is higher than the current price. I hope you enjoyed the video. It was just a quick rundown of companies that I believe are undervalued or that are worth looking into. Let me know what you think in the comments below. If you made it this far, then I would really appreciate if you could like and subscribe.